I'm just
I
going
use I use WebEx for my SEBI meeting, so I was less worried when it was WebEx. First, I thought it was Google Meets, so I was a little bit because I hardly use Google Meets, but this worked out. This is perfectly fine.
I remember during the COVID era, I mean, I was at Bloomberg and we were just so good with Zoom that we could like start Zoom and played like smoothly, for the entire duration of the event. But now, as things have started coming back, it's you know it's no longer as smooth. I mean, even I struggle with WebEx and Zoom, but back in the days it was like really really smooth.
No, I use all of this. Like today, I've been toggling between Zoom and Teams. WebEx is something, as I said, the regulator uses WebEx only. So because of SEBI interactions, when we're doing these brainstorming sessions, it works very well with them. But this Google Meets, I used to use it for my son's school. That's about it. And after that, I hardly used it. So that's something which I don't even know whether we have a firewall in office. So that's why I told Sandra that I hope it's not Google Meets. And luckily, it was WebEx, so I got saved.
But the regulator prefers WebEx, is it?
Yeah, they use WebEx.
Understood. Okay, I think we're about a couple of minutes away from the start, so we'll just allow people to kind of settle in, and then we're good to go, yeah, Lakshmi.
Perfectly fine, no problem.
So yesterday was quite the day, right, with the CPI number.
Yeah, every day is becoming quite a day now, actually.
No, I'm wondering how the world will look after the 20th of Jan, yeah, once he's taken oath. That'll be something, because yesterday I read like a ET story which spoke about how he's kept like 100 executive orders ready to fire. So it's going to be a watershed day for many markets, I think.
I'm sure. I think some of them are anyways happening in anticipation also, right?
Yeah, correct. Good. I think we're good to start if you're ready, Lakshmi.
I am always ready. Let's go for it.
Awesome. That is so good to hear. So, guys, welcome to this fireside chat with Lakshmi Iyer, who's taken time off her super busy schedule to talk to all of us, and I'm sure this is going to be an amazing hour of learnings for all of us. Quick introduction to Lakshmi. She's the CEO, Investment and Strategy at Kotak Alternate Asset Managers Limited. With over 22 years at the Kotak Group, Lakshmi has played many pivotal roles, from driving fixed income strategies as CIO to shaping innovative product solutions across asset classes like equities, real estate, and alternates. Lakshmi is an MBA in finance from NMIMS, and she began her career as a research analyst and has since become a trailblazer in the financial industry, earning accolades like Forbes W Power 2022, India's Impactful CEOs 2023, which is hosted by Times Now, and also one of ET Edge's most promising business leaders of Asia 2024. Beyond her work life, Lakshmi is an avid traveler, which I know, a food lover, and a passionate movie enthusiast. We'll talk about movies at some point in this discussion, Lakshmi. So let's all get ready for a very insightful conversation with one of the most influential voices in asset management. Lakshmi, it is such a pleasure to host you for this fireside chat. So thank you for joining us.
Thank you so much, and I look forward to our interaction today.
Thank you, Lakshmi. I think we'll dive straight in. I've got many questions for you, and like we said at the start, right? I mean, so many moving parts to financial markets these days. President-elect Trump is going to take oath for a second term, I think early next week, and therefore, the world of financial markets promises to be, quite the adventure over the next 4 years, is how I would like to put it. And that said, I think my first question, Lakshmi, to you was, there was this Bloomberg story that I read earlier this week, which quoted PIMCO saying that the uncertainty likely to be injected into the marketplace this year, with Trump, taking oath for his second term, is likely to become, another driver of attractive bond returns. Now, would you, given what you see and hear, subscribe to this view? And I ask you this because, it's a very, very bold call to be making. And in all of the conversations that I've had with people, I don't think anyone is really prepared for the next Fed move to be a hike. What are your thoughts on this?
No, I think absolutely. I think some of these views that you presented, are evolving every day, seemingly a very, very new day. Um we've had I'm sorry, I'm bringing in Bollywood too early, but when you're asking me this question, why I was reminded of the Bhool Bhulaiya OG series, then the series and the sequel that followed subsequently. Every time you are guessing who the booth is in the Bhool Bhulaiya, end up getting a very, very divergent answer. Sometimes you are guessing it is Anjulika, and then finally she turns out to be Manjulika. And that's exactly what is playing out in the US economy right now. So, if you look at the Fed fund futures, it is signaling not beyond two rate cuts. Had we had this chat maybe just about 72 hours back, or maybe even 48 hours back, probably some of them were talking about rate hikes, as you rightly alluded to. And then you have the inflation data in the US, which is still telling you that probably the rate cut bets are not off the table. So I think it's a confluence of factors which are playing on the markets, and of course on the bond market sentiments. But I have just a couple of points to mention to your point directly. If you see 2024, and of course I will give you parallels of India, and then we can flip that to the globe also, is that the fixed income delivered better returns than equities. So Nifty gave about 80% of returns, whereas bond markets gave double digit returns. Uh, I won't be surprised that given where yields are right now, whether it's in the US, it's not at four, closer to four, it's closer to five. In India, interest rates are not southward of 6.5, it is northward, towards the 7% region. I won't be surprised that on a risk adjusted basis, fixed income does deliver reasonable returns for the investors this year. To that extent, I would still maintain whether it's in the US or in India, the rate cuts are still not off the table. So we need to probably hazard a guess on rate cut hoga to bahut zyada hoga. It's not going to be like a steep rate cut cycle, more like a shallow rate cut cycle. But at this juncture, I'm not rooting for a rate hike for sure.
Understood. No, I think my thoughts are very similar, Lakshmi. And I've been looking at crude very closely over the last month or so. I mean, not too far back, crude was struggling to stay above 70. Now I think NYMEX is ticked about 80. I think that's something that we need to take into account as we make forecasts for where inflation, or at least the trajectory of inflation, might be over the next 6 months. I mean, like you said, right, a lot of moving parts. You really have to take it, I think, by the day, rather than, we're not living in this world where, we can make like 6 month long or 12-month long forecasts, because there's just so much happening on a daily basis. So I fully subscribe to the fact that we've got to take it, slow. See what kind of incoming data is coming in, and then like yesterday was one of those days, right? I mean, CPI every month is a very closely watched number, and the core CPI, excuse me, which was expected to be about 3%, I think came in at like 0.2%, and the reaction, at least from a risky asset standpoint, was so much more on the upside. Like, for example, US equities went up so much. It clearly shows that everyone's hoping that the Fed is not done with its rate cutting cycle. But I also subscribe to your point that even if we do get an additional cut, which the Fed fund futures market is thinking will happen, maybe a couple of them this year, I don't think it's really going to be a direction that they take and hold on to for a long time. So maybe it's, even if the next rate cut comes, it's going to be very fleeting rather than something that's going to hold out for the rest of the year. But having said that, I was looking at US unemployment, and roughly about 4-5 months ago, I saw the unemployment rate in the US tick up to 4.2%, and then it's come off. There was, I think, another attempt to breach through that 4.2% barrier that didn't come to fruition. Do you think, with unemployment not really spiking up in the US, maybe the Fed was too early to cut rates? And I remember they, came out with that monster 50 basis points cut in September. So the one aspect is that, and the other aspect is, with Donald Trump becoming POTUS for a second term, do you think if the data, starts showing that inflation is unlikely to go back to the Fed's neutral rate of 2%, the central bank will actually hike rates if inflation were to start pointing northwards? Or is that something that is a rate hike something that we should completely rule out given the current weight of the evidence? And I'm also saying this because, like I said at the start, oil is becoming, is making headlines for the wrong reasons from an inflation standpoint. So what do you think about that?
Akshay, my view is if market were an akhada or if market were to be like a chessboard, as a policy maker, you are actually playing, those who understand chess can relate to this, you are
Yeah.
actually playing a blitz game. You're not playing a classical. And to put it more for the cricket lovers, because cricket is a more followed game than chess, you're actually trying to play a shorter version of T20, not even an ODI, forget, let alone test match. So, you are in that era right now, and therefore, never say never. When you say 0%, you're overconfident. When you say 100%, you're super overconfident. So I would say the probability of all of this happening is between 1 and 99. That's the way I would put it. Given the fact that there are way too many sum of moving parts. Okay, one can draw some parallels from Mr. Trump in his previous regime and try to kind of extrapolate in terms of what he likes and what he doesn't like, and all of that. But again, that's all conjecture, right? Because ultimately we are followers of the market. We will try to decipher it in a slightly better manner. So if you look at the job data, the latest job data, for example, we've seen uh, beginning of the year, the number that we saw was sometime in March, north of 200,000 jobs. And then we saw that kind of a number get repeated last month in December. Now, looking at that, obviously, then your unemployment rate has ticked down. So, looking at that, does it argue for a rate cut? Probably no. But if you look at the earnings growth from corporate India, corporate US, sorry, then you look at wage growth, for example, there is no evidence yet of a massive acceleration in terms of the wage growth. So that pressure is not really there. Inflation, again, I told you the inflation numbers have shown some sort of a cooling off effect. So if I blend all that into one jar, that still keeps some window of I would say probability of rate cut. And we also must keep in mind that US was did the magnitude of rate hikes in the US were much higher. So therefore, they have to start easing. So I don't know whether US acted too fast, or I don't know what is the right timing to do all of this. Policymakers know it better. But as a practitioner of market, I would say it's always better safe than sorry. Though I know there is another school of thought which says that to err on the side of caution,
Yeah.
but too much of caution, you have to constantly play this tug of war between growth, inflation. And I think, have you seen this movie Vettayan? Vettayan is a Tamil movie, and
I
Vettayan
need to watch
actually
it. It's
means.
the one with Amitabh Bachchan and Rajnikant, right?
Yeah, that's right. So Veteran actually means hunter. So central bankers are actually like veteran or hunters who are waiting to shoot down inflation at the first sign that it. But in that process, they may also be mindful that they may be compromising on a lower growth. So I think that shikari giri or veteran giri that they are doing, that act I think will continue well into 2025. But if I were to give you one answer between rate hike or a rate cut, and if there's just one answer for which I have to be pinned down to, I would still vote in favor of a rate cut.
So you still think there is some sort of a window that probably makes the possibility of a rate cut a higher probability event when compared to a rate hike, given the information that we currently have. Okay.
That's
Okay.
right.
Then my next question is about China. I think Chinese equities have been in the news for the longest time, but what's happening in China's bond markets is now getting a lot of attention. We all know yields are collapsing. Some people are going as far as calling what's happening in China a deflationary growth year. In fact, I was looking at the government bond yields in China, and I saw that the one-year yield recently fell to the lowest since the Great Recession lows of 2008 2009, while the 10-year actually continues to sink to record lows. How much do you think the current China situation will start to matter to the world with Trump back in the hot seat?
So it will matter a lot. Like I was sharing with somebody yesterday, they asked me, what do you make of China bond deals? So I said, it was very instantaneous, Akshay, and I said, China is getting Japanified. And, that kind of summarizes the mode and mood. But in the global context, I would say, all EMs right now, and of course that's true for China also, are actually paying Lagan. And you pay Lagan to whom? To the guru, and the guru is the US in this case.
Correct.
So, yes, definitely there is no two ways about it. That, whether it is protectionism or whether it is tariff wars, it will impact countries like Canada, Mexico, China. And China definitely, in that entire jigsaw puzzle, assumes a very, very significant role. So, I'm saying that. And again, I'm sure most of us or all of us would have seen the movie Lagan. While China is mentally prepared to pay the Lagan, it is also prepared to play the game of cricket. And when I say play the game of cricket, it is getting mentally prepared that, okay, if my guru or if the guru, the economy guru, China can't call US its guru, but if the economy guru will keep asking for more Lagan, then we will challenge him to a match. And exactly, if I try to extrapolate the Lagan movie, that's exactly what is playing out between countries like US and EMs, but specifically China right now. So I don't think China will stay quiet. But yes, at the current juncture, their chips are low. They have to obviously ride out this, pain point. Contrary to an expectation of a steep yield curve, if the entire curve has shifted lower, that's kind of getting people a little bit concerned about the long-term sustainability of the outlook. I mean, the economic outlook. And if you look at the way we track, CPI for all countries, China's CPI has actually remained flattish. It's not really moved up or down. But if you look at China's PPI, which is the producer price index, that's actually showing a decelerating trend, and rightly so. And that obviously is a great harbinger or a precursor to a significant cooling off of the economy. So yes, definitely what happens on 20th is something which, so if the farmers in movie Lagan were looking to the skies, people in China will be looking towards the US.
Yeah, I mean, I've been following China very closely, Lakshmi, and I remember very well that Bank of China and the government have announced so many stimulus measures. A couple of bazookas, was what they called, a couple of them. But nothing's really worked. So people are really thinking, how deep does this rabbit hole really go if they are truly at the cusp of a deflationary spiral on the way down? So it's interesting. But yeah, I mean, the US obviously will matter to the fate of China. There's no two ways about it. Let's come home.
As I said, actually, don't forget the match. Remember the match. The villagers won the match, but I don't know in this warfare what happens. But let's not rule out anything right now.
I agree. I agree. We've gone around the world. I mean, we've spoken a lot about the US. We've come to China. Let's come back home. Now, if I just dial back maybe 3 months from here, everyone was kind of confident about a February rate cut from the RBI after that, quarterly GDP shocker that came in towards the end of November. But now, the world looks very different. The rupee is in some sort of a free fall. I mean, it suddenly woke up from its 2 year slumber, and we're all seeing what's happening. Now, given that backdrop, do you think people are dialing back on those bets for a rate cut in February? Where I'm really coming from is, conventional economics tells us that if a country were to reduce its interest rates, the currency will feel even more pain. So, what's your take given that backdrop, and when the RBI will pivot lower, if they do, given the evidence that we are currently seeing?
So, actually, if bad news has to take the elevator and good news has to take the stairs, I would say that the dollar appreciation, almost little under 10%, and the rupee depreciation, of course, true for other EM currencies also, has played out as the bad news much faster than anticipated. So at the start of the year, when one said, okay, rupee will depreciate and the typical stuff, one would have expected all of this to play out over the next 3 to 4 quarters, not over 2 or 3 weeks. So I think some bit of, or I would say a large bit of negative discounting of news has already happened. Point number one. Point number two is, RBI has always mentioned that my basis of a rate action is always based on forward-looking data, not on what data I am seeing today. So, well, we do have December CPI, which has come down, substantively, or maybe 20, 30 basis points in this market is also substantive. That number definitely has given some elbow room of comfort. Look at the food prices, right? There also, if you look at the momentum, we track just not the food prices, but also the momentum of food prices. That also has fallen off. And with a great kharif crop, you are going to see food prices, which is intuitively such a big part of the inflation basket, that also under control. So if all of that is true, and the next maybe 4-5 readings of inflation is not going to overshoot, but maybe at or undershoot RBI's forecast, because you will see seasonality, vegetable prices will cool off. Then the opportunity or a window of rate cut still has to remain. The question is that should it happen in Feb or in April? But that is, if you had asked me this 3 months back, I would have still said that there'll be 2 rate cuts in 2025, one in Feb, between Feb and April, kind of a little bit tone, but more veering towards Feb, and then probably one after April. So 2 rate cuts for the year. So while I'm still maintaining my view of 2 rate cuts in 2025, I'm still a little bit torn because of what we are seeing around us, and recency bias tends to play truant to your assumptions. Though I still believe market has Gajini memory and things will be forgotten, it'll be more of a short-term memory loss. So I think Feb cut will be a very close one right now, given that there is a potential threat on the rupee. And one can't say, while I know we are resilient and all that is really great, one can't say all is absolutely well. Plus, this comes at a time when your trade deficit also has widened. So it's okay in our case, since we are not dying and desperate for a clarion call for rate cut nahi hoga to consumption toot jayega. If nothing of that is true, maybe we can just wait it out, for one more or a couple of more data points, and then take a call. And by the way, why do we have to Feb के बाद April में ही होगा? अगर ठीक बात नहीं लगे, it's absolutely okay to cut with, or act within meetings if the need were to be. But for now, I think it's okay if they keep it on hold in Feb. It's fine.
Understood. No, that's interesting. And that brings me to my next question about the oft-spoken, 60% in equities, 40% in bonds portfolio. Is that still the way to go? I asked you this question, Lakshmi, is because that portfolio hasn't really done particularly well in the last few years.
Yeah. So, honestly, actually, I'm not a big fan of any of these hard coding of 60-40 portfolios. It sounds very stylish, I know that, but I always tell people risk jitna hai na, and risk is a definition of how much is the tolerance for you to assume that your 100 rupees becomes zero. I mean, literally, if that goes off, I tell people that. And that is my definition of risk capital. That's a money to lose. And if your risk appetite is high and you do not require your money, I tell them pump it into equities and just sit through it. I have been sitting my own personal portfolio. I've been more than 90% equities for like over a decade plus now, maybe a decade and a half plus. And then again, this all varies depending on which life stage you are and all of that. But long story short, I would say 2 things are a non-negotiable: have some geographical diversification, and definitely have some money in gold. So these 2 things for me are a non-negotiable as part of your overall asset allocation. But prototyping and putting a cast in stone is not something which works well for me.
Understood. In a globalized world like the one we're in today, everything moves everything. So my next question to you, Lakshmi, is about commodities, right? They're seemingly starting to wake up from their own slumber. So you mentioned gold, and gold obviously came within a whisker of hitting like $3,000 a couple of months ago. In India, I think gold topped 80,000. Crude, like I said before, has rallied about $15 from its $65 drops seen about 4 months ago. Cocoa prices have indirect. Chocolates are getting more expensive. Nat gas is up like 150% from its lows in March. It's all happening at the same time, right? Just as Trump readies for his next term. What does all of this mean for the long versus the short end of the global inflation story? Is what I would really like to know your next set of thoughts on.
No, so it will definitely, crude oil prices being high, nat gas prices. Why only these commodities? Crypto has behaved like
Yeah,
Sarfira in 2024. It's been like really crazy,
you
and
know,
commodities are actually.
crypto's doing what crypto does. So
Absolutely, absolutely. So I think definitely if the momentum sustains, it's not great news from an inflation standpoint. And that is why I said that globally, while the trend would still mean an easing bias, but for the exception of Japan, I would say, I will maintain that the rate easing cycles will be pretty shallow, given the fact that for every dot there will be an antidote. So there will be a classic tug of war where higher commodity prices by desire or by design. It largely happens by design, given, and it's soft agri commodities, base metals, all of them kind of looking up at different points in time, can kind of temper the sentiments from how much can policymakers ease out,
yeah,
because that will again stoke another round of unintended inflation. And as I said, they are the inflation vigilance, or the Betian, as I said in Tollywood terms. So I think that will definitely be, in fact, that's my biggest concern for. I wouldn't say biggest concern, but that's definitely one of the key concerns for this year. That the confluence of events. I know we are having the Mahakumbh, and there is a Triveni Sangam, but here the confluence of these three factors, rising crude, not so easing inflation, and slowing down growth, may not be a very great confluence to effect rate cuts.
yeah. No discussion, Lakshmi, is ever complete without talking about the dollar. So I'll throw that into the mix now. Clearly, the elephant in the room. We've seen, I think, this dollar rally that, and I believe the dollar index is currently, touching 110, or maybe it did like earlier this week. So clearly, the elephant in the room. It's probably benefiting from the fact that US bonds are becoming great investments with the 10-year, hovering close to 5%. Now, what reasons would you attribute to, the dollar bull case continuing from where we are? And what reasons can you think of for the dollar's rally to finally stall in reverse? How are you looking at that world?
So I would say in the currency Maidan today, there's only one Mufasa, and that Mufasa is the US dollar. And
Well said.
there is, and there is, I would say, yet to see that Scar, which can actually slay the Mufasa. Where, of course, Scar was the one responsible for Mufasa's death in Lion King. But yeah, right now this king is prevailing, and let's look at the key reasons, and we know pretty much all the reasons. Um, and job growth rebound, stating that all is well. The probability of recession in the US now has dipped down to under 20%,
That's
which
correct.
was, numbers were floating from 40, 50, 70, and all of those things. Now, these are a lot of confidence boosting measures to own the mother of all currencies, right? I mean, I know there have been gazillions of book being written ever since I was born, calling the death of the dollar.
Yes.
I think those say that, okay, I'm going to keep competing with Niagara Falls. That's not going to happen for now. And we need to also be mindful of the fact that, yes, a good, if you're going to expect the same pace of strength, probably I think that's also not realistic, not
Yeah.
pragmatic, because anything that goes up has to come down. We've all, known this principle, or the karma cycle, as they call it. But I think in the near term, the dollar is here to maintain its strength. What can fizzle it off? Obviously, data, and more data. And what kind of I would say US inward looking measures that Trump will announce, that will set the ball rolling for the next I would say series of movement for the currency, which in our mind, as I said, may not be very negative dollar. It can kind of linger around that because a lot of expectation trade has got funneled into the dollar right now. So even a little bit of disappointment will actually see it retrace. But as I said, I mean, it's Mufasa ruling for now. So yes, we have to live with the fact, and hope and pray that Mufasa mentors Simba well enough, to effect the next dahad in the currency markets.
No, that's such amazing analogies, Lakshmi. Now, that said, and given all that's happening around us, what would be your recommendation to someone wanting to take an exposure to, let's say, domestic, bonds? For instance, let's say, somebody had like 100 rupees in his kitty. What kind of allocation in bonds would you recommend to someone in his mid 30s or early 50s versus a retiree? And I know from one of the things that you mentioned just a while ago, you said it really depends on which part of your life you're at. So how would you tackle that?
Yeah, I would say if you're in your mid 30s, why are you even buying bonds? You should just buy just buy tons of equities and sit on it, and in a decade plus, it will create enough and more wealth for you than the bond will do for you in 3 decades. I think that is
Correct.
my point number one. Have some small amount as I said, as an exigency sort of a thing, which can be kept in sovereign bonds, and sovereign bonds where they are at the current juncture, with some more probable uptick in yields, which cannot be ruled out totally. They look incrementally fairly okay to hold on, or buy more and just sit on it, and of course play some carry initially and then play the potential capital gains game. But otherwise, as I said, if your appetite for risk, depending on your age, maybe lesser on your age and more towards what you want to allocate. But yes, if you're very very clear, irrespective of what cycle I'm not cut out for any risk of the markets.
Hmm.
Then go long bonds. It's absolutely okay to go long bonds. As I said, stagger your
Hmm.
deployment plan between now and say next couple of months, because you have the budget also, right?
Yeah.
So which is not we want to believe that we will toe the line of fiscal discipline, which we had taken a breather during the COVID times. I think all of that should play well for bond yields as well.
Understood. I think it's a good time, Lakshmi, for us to, for you to kind of walk us through your boldest calls for 2025, majorly bond yields, because you've done so much fixed income. But really, feel free to talk about anything that you think investors should really care about.
No, so as I said, at when yields are towards the 7% region, yes, I would own fixed income. Risk reward does favor owning fixed income at the current juncture. I'm not denying that at all. I'd still continue to buy gold at the current levels. I don't understand crypto. I tell people, ask a 20 minus in age. I am 40 plus in age. With respect to crypto, they are the better view providers and money makers there.
You know,
But yes, otherwise.
I have to come
Sorry?
in there and tell you, Lakshmi, that I'm sailing in the same boat. I've really tried hard to understand crypto, at least from a fundamental standpoint, but I think I gave up, and for a good reason. So,
So good, you at least tried and gave up. I said it's not my forte. Let the poor competent people, as I said, who are 20 minus in age, attempt that and make a killing of it. I'm happy being a philosopher in crypto, and I'm happy looking at the practitioners of crypto make it lose money. But yeah, I think that's where I would lay my bets on. I would also bet on the US equities at the
hmm.
current juncture, specifically given the fact that they have been the torchbearers of innovation. They continue to be the hub of anything in breakthrough and stuff like that. So I think from a geographical perspective, I would definitely own US, not any other country right now. And within India, as I said, bonds maybe with a little bit more uptick in yields, and gold in the portfolio for sure.
Understood. That brings me to my final question, Lakshmi. Any final thoughts for our listeners in terms of the most important takeaway for this year that you want them to have? Or should we just wait till the 20th of Jan?
I think this wait and watch game will always make you oscillate between FOMO, which is fear of missing out, and JOMO, which is joy of missing out. So when markets crap off, you're always the J factor is high, the joy, and when the market starts rallying, like today the markets are in green, and then somebody will say, "Oh my God, why the hell didn't I invest yesterday?" So, this wait and watch game is not something which I recommend any investor to do. As I said, markets will continue to have its what do I say, sarfira moments, and there will be a lot of ulaj in our minds. But I think that is where we need to display, I would say, our Yoda attitude. And markets में एक ही principle है, लगे रहो. I think that's what I would say.
Awesome, yeah, Lakshmi. It's been such a pleasure talking to you, and I'm sure I speak for everyone on this webinar as well. And there is no denying that we would obviously want to feature you again because I mean, just the way you connect the dots with Bollywood and what's really happening in the marketplace is a fresh thing. So thank you, Lakshmi, for your time, and we'll talk to you soon. Take care.
Awesome. Thank you so much. Take care,
Thank
guys.
you.
Bye.
Thank
See you.
you. Bye.